It's tax season. Hopefully that means a tax refund to you. Here are 4 things that you can do with that tax return to improve your net worth. Strategy number 1, reinvest into your TFSA. If you contribute to RSPs with the net dollars from your bank account, take your refund and put the same tax return proportion into that TFSA. What do I mean here? Well, let's say you're in a 36% marginal tax bracket. Then you put $10,000 into RSPs and you get the full 36% back on that $10,000. So that would mean $3,600 coming your way as a tax refund. You can take that and reinvest it in your TFSA. Then you're growing 2 pots of retirement income going forward. In this scenario, it's even more ideal if you're in that same 36% marginal tax bracket while working and then decrease to a lower marginal tax bracket in retirement. Then you make up the margin of difference on taxes paid on withdrawing the same $10,000 in retirement, assuming you drop to a 30.5% tax bracket. Or in this case, 5.5% or $550 less dollars paid to taxes and pulling out the same $10,000. Now take the 30.5% tax bracket from the $10,000 and you're left with $6,950 in your pocket. Plus the $3,600 from your TFSA works out to $10,550 in your retirement. Strategy number 2, reinvest into your RSP. Using the same strategy as before, except putting the tax return back into the same RSP would give you a tax break for the next year and further boost your tax return if you're putting in the same $10,000 in that year on top of the $3,600 return. So instead of a $3,600 return, you would get a $4,896 return, assuming the full $13,600 is refunded at that same 36% bracket. Then you continue this effect year after year, building the amount that goes into your RSP and compounding the tax return again and again and again. Strategy number 3, pay down high interest debt. Use the refund to tackle the highest interest debt you have. This is likely a credit card, potentially a 20% interest unsecured loan around 9 to 11, or a car loan at 6%, for example. Looking forward, average investment returns won't be quite as high as 20%, so paying down that interest will save you monthly money going forward. For example, if you have $10,000 on a 20% credit card, that works out to roughly $166 per month. Just in interest. Paying down your $10,000 credit card to $6,400 would mean an ongoing monthly interest cost of $106 per month instead. Strategy number 4, pay down other debt. This could be a low interest car loan, that could be at 2 or 3%. You could pay down your mortgage, which looking at rates over the last 5 years is likely low as well. Usually it makes the most sense to put your money where you're either growing your savings the best or paying off the highest interest rate. But again, paying these down is increasing your net worth going forward, which could be ideal for you too. Hopefully these strategies help you make a good decision with your tax return. If you have any questions or want to see a video on another topic, please comment below. Reach out to myself or another CFP professional to see if these strategies work for you. I'll see you next time.